Well, welcome to the Wisdom of Wealth podcast. As always, I'm your host, Kyle Kempers, and I'm here with Ryan Haley today. And I'm specifically excited about this podcast because we are diving into an illustration that will help those of you understand the infinite banking concept in more detail than we've been able to go into up to this point. And so, with that being said, if you're listening to this on audio, you may want to find a computer or potentially on your phone and not while you're driving. Look up the video that we'll leave a link to in the show notes because we are going to be looking over some numbers today. Ryan's going to be walking us through a supplemental illustration and talking through the details of how this works. And so, if you're jumping into the conversation with us today, and this is the first time you're hearing the words infinite banking concept, then I want to inform you that we are probably on chapter 7 of the book. And so it'd be wise to go back and listen to some of the podcasts that we've already done, as well as some of Nelson Nash's material to give yourself some context for this conversation today. And so without further ado, Ryan, would you take it away and explain what all these numbers on the screen mean?
Yeah, absolutely. And again, this is our promise. It's been a long time coming to just jump into the numbers since we've had a lot of feedback and requests from different people about that. And so following up on our last episode, this series, we're going kind of doing our deep dive into the infinite banking concept and cash value life insurance. This is, as promised, the actual numbers on an illustration. And again, as Kyle said, this really is meant to be a visual experience. It's going to be hard to follow if you're just listening to audio. So please do click on the link in the show notes to go to the YouTube video and so you can follow along with us. But just jumping right into it, this is kind of a generic policy on a hypothetical client. This is assumed to be a male, age 40, good health rating, but not the best. And this is also a whole life policy with a combination of different features that are really important. We've mentioned this before, how when you're talking about true infinite banking, a cash value optimized policy, the design of the policy is critically important to maximizing that cash value for the purposes of using this as, a banking mechanism to fund investments and business opportunities. So we've talked a little bit about this in the past, and we'll probably mention it in future episodes, but just to give some context before showing these numbers, and this is stuff that, like Kyle said, you want to make sure that it's assumed you're going to already know this or do some research, but this particular policy was set up using a 20% base premium and an 80% paid up addition, which the paid up addition, or PUA, is kind of the cash value supercharger, if you will. And it's also got a term rider on it. And we're not going to go into all the mechanics and specifics of what all those things mean, but all that to say, it's just really important to understand how the policy is designed and the assumptions within it. So this is what we refer to as an 80-20 split. And that means that 80% of the premium is going towards that paid up addition and 20% to the base premium. So it's minimizing the death benefit in relation to the cash value, and therefore the growth will be a lot higher because of that. So now another important thing about this illustration is we're going to be going over the supplemental illustration, as Kyle said, the internal rate of return, to show you kind of a summation of what the whole policy looks like. Now, one thing that people love about whole life is that it's got those guarantees, and that's great, but there's also a non-guaranteed element of whole life policies, which is the dividend. And while we think these projections or these illustrations are conservative, it does include a non-guaranteed portion that consists of the dividend, but that is probably the lowest dividend illustrated rate that we've ever seen in history. So we think it's conservative, but just understand there's a guaranteed and a non-guaranteed element to this. So before I jump in, Kyle, do you have any questions or thoughts about any of that?
No, I think that you've about set it up perfect. So yeah, let's dive into it, start talking through the numbers and what they all mean.
Right. And if you're intimidated by these numbers, I only used 100,000 as the annual premium because the numbers and the math are really easy to follow, but you could drop a zero, add a zero, move the decimal place. Generally speaking, these ratios scale proportionately, but for reasons you'll see, it just makes the math easier when we use 100,000 as a round number. So just jumping in here, this client is starting off putting $100,000 premium into this whole life policy at the age of 40. And so at the end, that's important to see at the end of this year. That's what all these illustrations are based on. At the end of that first year, they'll have about $78,000 of cash value. In fact, technically, pretty much if he did this as a lump sum, he would have that pretty much immediately available to him. And so this is not something you have to wait forever and ever to access the money in here. So obviously you can see you're a little bit behind, right? You put in 100,000 and you only have access to 78,000, and call it 75,000 because usually you can borrow about 95% of that cash value. And so if there's 78,000 of cash value, the amount you could actually borrow would be about 75,000. So you're starting off a little bit behind, right? And that's what a lot of people initially have a problem with is, I'm putting 100,000 into this. I want to do a real estate deal or some kind of investment. Now I've lost access essentially to, call it $25,000 right off the bat. And that is true, right? And it's important to understand that this is a long-term play. Now, obviously you have this over $2 million death benefit here, which is important. And there's some other benefits in the policy, but we're assuming that you're really only concerned with the cash value. So at first, this is going to put you slightly behind, right? And then as you put another 100,000 in, you're less and less behind, because as time goes on, what you're putting in the policy is less than the amount of the increase. So as this cash value increases more than the premium that you put in, you can see that by end of year 6, you're cash in, cash out whole. So at that point, you've put in $700,000, then you've got just over 700,000 of cash value. You've got a death benefit of 3.5 million. And then you'll see that every year after that, it continues to increase. And then this particular illustration, and there's any number of ways you could do this, we assumed that you would only be funding it for 10 years and then nothing ever again. So you can see here the outlay, that's the premium that you're paying in. This next column is the accumulated outlay. It's just the total, right? So put 100,000 in the first year, 100,000 the second year, your total cumulative outlay at that point is 200,000, et cetera. So after 10 years, you've put in $1 million of premium. And at that point, you've got over $1 million of cash value. And of course, you've got this death benefit too. But what's really important to see is that after year 10, you're never putting anything in ever again in this particular illustration. Not that you couldn't, but that's kind of the vanilla starting point that we do with these max funded policies for 7 or 10 years, something like that. And you might look at this and say 3.5%, man, that's like, I can get 20 or 30% in some of my real estate or other investment deals. Why would I do this? And Kyle, what would you say to that?
That is a fantastic question. I would say for myself personally, because we've mentioned this in prior episodes, but Ryan and I got into this on the user end before we got into this on the marketing end and actually setting people up on the agent side. And so as a user, what helped me when understanding how infinite banking plays a role in my financial strategy is that this is a banking strategy, not an investment strategy. So if we're looking at the internal rate of return, I want to compare this against a bank account, not compare it against a investment portfolio. And I think that it seems to be one of the hardest the learning curves, I guess, when it comes to getting into this entire strategy, is getting over the fact that we're not looking at replacing your investments. We're actually looking at trying to do both and I think it's important to note that between years 3 and 4, you'll see that you're actually cash flow positive. So you're putting in that 100K from year 3 to 4, and it's going from 270,000 and some change to 371,000 and literally $8 change. But that number is really important because in that year we're not feeling the burden of the cost of this policy. And so we've got access to that cash value that year to be able to invest it. And we then, after that year going forward, are recouping inside of our cash value the initial cost, the outlay of the first several years, on our way to being made whole at year 7. So hopefully that makes sense. I would look at this as more of a banking strategy and how we can leverage this as a bank, less of how can we leverage this as an investment vehicle.
Yeah, well said, Kyle. And to that point, I've shown you another supplemental illustration that shows the cash value annual increase here in this column. So you can actually see those numbers broken down. And again, you are slightly behind at first. You're putting in 100,000, you got 78 of cash value, then 95, then 96. So you're actually cash flow negative those first 3 years. But look what happens starting in year 4. You're pretty much cash flow break even year 4. You put in 100,000, you've got almost exactly $100,000 increase that year. And then you start seeing slowly but surely the cash value increase becomes quite a bit more than what you're putting in. So by year 10, when you're putting in $100,000 premium in that single year alone, your cash value increased by over $130,000. And on an annual return basis, that's a pretty good return to be getting a virtually guaranteed. Again, not all of this is guaranteed, but most of that is going to be guaranteed at this point. And that's a tax-free, because this is a non-MEC, which means that it's in conformance with IRS guidelines that this will not be taxable. So, on that single year, you basically got over a 30% tax-free return. And if you adjust that for taxes, if you're in the 25% tax bracket, that 30% return is probably closer to, 40%. Not bad for a single year. Now, at that point, you're not totally, you're a little bit ahead, right? You put in $1 million, you've got 1,080,000 and change, but it's what keeps happening after that. And I'll pause there for a second if you've got something, Kyle.
Yeah, totally. I think it is important to just remind everyone that this is assuming that we're loaning against the policy and not withdrawing from it. So when you're seeing these increases, as Ryan has referenced, we're not accessing those increases by withdrawing them against the cash value, which would decrease our cash value. We're just taking a loan against it, which operates very similar to a HELOC, like equity in a home. You don't cut the garage off the house when you take a HELOC, saying that we're taking that amount of value out of the home to then place it somewhere else. We're actually just taking a loan. It's a 1-to-1. It's ratio. It's just a loan against value. So we're accessing the cash inside of this policy through loans. So just wanted to point that out as we continue.
Yeah, and this is not assuming any loans yet at this point. This is just we'll get to that, but that's a good point, Kyle, because obviously if you were using this cash throughout this whole period, which is the whole point, obviously then you would want to make sure that you are not withdrawing, because then you wouldn't have as much. And we'll get into that in a bit, but that is an important point. But just in the most basic sense, if you didn't take any loans or withdrawals, this is what it would look like. And again, the point being that you're gonna be behind at the beginning, right? Like, not horribly, but it's going to take you, in this particular example with all the variables and assumptions, it's going to take you about 6 years just to break even with how much you put into the policy. But you can see, like Kyle said, starting in year 4 on an annual basis, you're cash flow positive. Now, here's the part where it gets really interesting. After year 10, in this case, at this guy at the age of 50, he's putting nothing in. And every year, look at that, his cash value now is going up by over $50,000 in year 11, 53,000 the next year. By year 20, the cash value is increasing by over $77,000, and he has not put in a single penny after year 10. So this is where these first 10 years is not so much that you're going to be making a whole lot of money inside the policy. You're capitalizing your banking system so that you can stop funding it at some point eventually, and it will be the gift that keeps on giving. And as you can see, that's pretty significant. By the time this guy is 65, what used to be the old retirement age, on an annual basis, this policy is kicking off over $90,000 of tax-free returns. And then, if he lives to the ripe old age of 95, in that single year, the cash value is increasing by over $200,000. So this is, again, it's a long-term strategy. It's not a get-rich-quick scheme, and it's conservative. You're not making a crazy high rate of return. If we go back to the other illustration with that internal rate of return at age 95, at that point, the cumulative net compound return, or IRR, is a little under 4%. Now, that doesn't sound very impressive, but look what that actually means. In this case, over 55 years, the compounding is significant because you put in $1 million, and at that point, you have over $7 million of cash value. And then the death benefit obviously is even more than that. So, I mean, that's a 7x return on capital, if you will. And it only took just under a 4% rate of return. So this really just illustrates the power of long-term uninterrupted compounding.
Yeah, and it's beautiful that we're doing this inside of whole life insurance because we also have the advantage of having a death benefit. So alongside of however you're leveraging your cash value in those early or even later years, that death benefit is going to help offset some of the risks that you may or may not be taking in your investment strategies, which all of us that are in finance understand that there's some level of risk to obtaining reward. And so this does add a great umbrella and measure of a hedge against the risk that you may find yourself in. And you can even structure these policies in different ways, depending on if it's personal or if it's business owned, which we probably don't have time to get into all the nuances of that today. But the way that we want to structure this is with that death benefit in mind. We don't want to forget about the death benefit. Obviously, we're looking at these returns and we're excited about what we're trying to do with the cash inside the policy. But the beautiful thing about doing this inside of a whole life product is the provided benefit and umbrella of death benefit that's provided by purchasing it through this policy through a mutually owned whole life.
Yeah, and that's a really good point, pal, is that it's critical not only that you structure the policy correctly, it's really important that you use the right company. And we're not advocating or promoting a certain company, but just in general, you really want to make sure that you use a highly rated, long-time, conservative mutual carrier, not a stock company, because mutual carriers are aligned with policyholder interests, whereas stock companies are aligned with shareholders. And I've experienced both sides of that coin. And let me tell you, it's much, much better being with a good mutual carrier. So again, we've talked about those things in the past, but it's important to reiterate, if you're going to be putting a significant portion of your net worth into these policies, you want to make sure it's with the sound financial institution. And mutual carriers that are highly rated have been some of, if not the most sound financial institutions throughout history. When banks and mortgage lenders and investment firms were going out of business multiple times throughout history, really sound mutual carriers were paying whole life dividends throughout the Great Depression, throughout the Civil War, throughout 2008. I mean, that's really important. So again, this isn't meant to be a high return investment. It's a supplement to the investment and the business opportunities that you can use the policy to fund, which is really going to generate by far the higher return over time, most likely. But really, what this is kind of a supplement or replacement for is your checking or savings account to be funding all those deals from. Because like Kyle said, if you could even get, let's just say 4% long-term in a bank account, which I don't think anybody's getting anything close to that now, but even if you could at these very large volumes, the problem with the bank account, or even in like a 401k or a retirement IRA or something like that, is any regular type of account, in order to access the money, you have to spend it down. And therefore, any compounding or earnings that were being created from the principal is being drained, right? And so that's why when you're talking about a lot of financial planning, long-term retirement type scenarios, you have to have what's called a safe withdrawal rate, because even though that account is earning some kind of return, as you start accessing it and withdrawing it, you're drawing down the corpus or the principal that is generating those returns. And eventually you're probably going to drain all the money out of the account. Whereas with this, like Kyle said, if we're using loans instead of withdrawals, then you're never, ever reducing the amount of cash value that's in this policy. So the entire amount is continuously compounding. And as we see here, even a modest long-term return of 4% is pretty significant over the long term, you know? So I think that's just an important thing to understand, is how you structure the policy, which company you use to issue the policy, and then how you're accessing the money in the policy when you start taking distributions, quote unquote, if you will.
Yeah, that was well said, Ryan. And I also think it's important to point out that knowing the context, your financial context of how you get into infinite banking is extremely important. And this is really where it comes down to our roles as agents. But both Ryan and I have spent a considerable amount of time learning and studying how these things work and how they build. And obviously, as you can see, the need for consistency is absolutely key. And so you're not going to be building a 100K a year policy off your income and running everything you have through a policy and borrowing against it as it goes in, because we're not going to be building a safe vehicle. And there are stipulations and guidelines in place about how much of your available cash or your cash flow, your free cash flow, that you can allocate to this type of product. So we definitely don't want you to be off put by the numbers, because you may be an individual that could do more than 100K and it wouldn't cause any issues, and you would be able to proceed forward with the confidence that you can provide the consistency that the policy needs. But you also may be in the boat of doing $10,000 or $20,000 a year, and then that's the safe amount. And even when my wife and I started this, we started with less than 30%. I think it was actually quite less than that. It was less than 20% of the available cash that we wanted to start a policy with. And it's just because we wanted to be conservative. We wanted to slow build it. And so as much as it can get really exciting to see numbers and try to figure out how to get that number as high as possible, I do want to just preface it with saying that that's why the conversation that you have in the future with one of the agents from Unbridled Wealth is absolutely key to building this the correct way.
Yeah, that's another good point. And that comes back to the policy design. But I would say more than anything, it's not just about the policy design or the mutual carrier or how you take access to cash. You could do all that correctly, but more than anything, it needs to be part of a comprehensive, very well-designed, strategic, long-term financial plan, right? So these policies don't exist in a vacuum, right? Now, you could use this as a standalone vehicle, but you'd be, I think, really shortchanging yourself. So it's super important that you're approaching this from a comprehensive financial planning viewpoint. Now, that doesn't mean that the agent has to be a certified financial planner or an investment advisor or any of those things. It just means that they and you need to be really diligent in collecting all the information up front to make sure that not only the policy, the product, the design is in your best interest, but how are you going to use it? What's the overall big picture strategy in how this thing is going to be part of the plan? And also, of course, the details are important as well. So as many things in IBC, it's both and. And so again, this is not meant to be a comprehensive, discussion of the whole concept, but it is something that we just wanted to show you as we've been talking about. Here are some actual numbers. You can see what this looks like. Again, it's just an example with a number of assumptions, but I think it's fairly representative of the type of policy that we are typically looking at. Again, whether it's 10,000, 100,000, 500,000, the basic idea is the same. And so we're going to get into some more episodes where we'll break things down further, but that is kind of just the short and sweet. Here's your first look at an illustration. Again, there's so many things that we could talk about with this, but go back, listen to the other episodes, watch the YouTube video if you haven't already. And then the best thing by far is, again, we can't do this in a vacuum. So if you're really interested in this, there's no replacement for setting up an appointment, getting an individualized, custom tailored financial review and strategy session, because that is going to be the most important thing. There are so many questions that come up, and the answer 99% of the time is going to be, it depends. So that's where just scheduling an appointment with somebody is going to be really important. And of course, as always, you can go to wisdomofwealth.co and you can click on a link, and that'll take you to a webpage where you can learn more and schedule an appointment with Kyle or myself or any number of people on the Unbridled Wealth team. And you don't necessarily even have to work with us, but we just are, again, we're passionate about financial education. So whoever you do work with, you want to make sure that they know what they're doing, that they're being upfront with you and honest, and that all your questions are answered, and that you have as much information going into this as you possibly can. So we will be following up next week with another episode, getting into some other details, but I think that's kind of our intro at long last, making good on our promise to show you guys an actual illustration. And Kyle, I don't know if you have any other concluding thoughts.
Yeah, I just want to agree with everything you said, as well as just say thank you to each one of you guys that have been listening to this podcast for your patience. I know it took us couple extra weeks to get this one up, but we just want to make sure that we were putting together the right content, and we've also both been traveling quite a bit. So thank you for your patience. And I think the only other thing I was thinking of is just that the thing that can affect your cash value or those numbers the most is your health rating. And so once you get into that conversation with the agent that you decide to have a conversation with, they're going to bring that up. But I just don't want anyone to be surprised that you have to go through underwriting to get a good, clear picture of what you're actually looking at. And I've had individuals who have spent months looking through policies, illustrations, and strategizing, all to come down to not being able to even get approved for life insurance. So I just encourage you to not let that be a barrier to entry, and to do it sooner than later, so that
Yes.
you don't have any surprises on the back end, and don't end up having to run a family member through underwriting to write it on them. I mean, there's so many different creative ways to build these policies. But I would just encourage you. It's paid for by the carrier. I did it right away when I started looking into the product, and they just do like the blood sample and urine test, and for the most part it's fairly simple, and getting that done is I just want to encourage you, if you're listening to this, I want to try to remove that barrier to entry, because it is so much more helpful when you're trying to look at illustrations for your own personal strategy, and it's based on your actual health rating.
Yes, that's a great point, Kyle. And that's what I would tell most clients is, I've had the same thing where I talk to them for 3 or 6 months, and they finally, are ready to go. And then they want to put $500,000 in 2 weeks. And it's going to take a lot longer than that, especially at that number. So, and then on that particular case, yeah, we had a surprise with the health rating. It wasn't terrible, but it wasn't as good as we thought. So the bottom line being, if you're reasonably confident that you're going to move forward, it's just a matter of the details. There's no cost or commitment to getting an application and underwriting, because at the end of the day, this is all completely hypothetical until you get an offer from the insurance company. Then we can give you actual real numbers. But until then, it's total speculation. So great point on that, Kyle. Get in, get the education first. If you feel you're at the point where you're ready to move forward, then start the underwriting as soon as possible. Again, it's pretty painless for the most part. And the sooner you have an offer, the sooner you have real numbers. But again, I chose this example because I thought it was fairly representative, but it will totally depend on a number of variables. So with all that said, we're going to follow up with another one, but we hope that this kind of scratched the itch, so to speak, of what we've been talking about for a long time. And we look forward to going over some more stuff on the next episode.